Hello and welcome back to our discussion. In the previous session we saw the deferred tax liabilities and deferred tax asset. In this session we will try to understand, will deferred tax liabilities and deferred tax asset anyway affect the calculation of EVA. We know that deferred tax is a GAAP number, whereas EVA is a non-GAAP performance indicator. So EVA says if the financial statements have deferred tax assets, liabilities or deferred tax, they should be ignored while computing the economic value added. We will try to understand the effect of removing the deferred tax while computing the EVA. So the deferred tax will affect the EVA because it affects the NOPAT and also affects the capital charge in the form of effect on the capital employed. So we have seen this question, and we have the deferred tax liabilities, deferred tax on the balance sheet, on the income statement, and deferred tax liabilities, net deferred tax liabilities on the balance sheet. How will these affect? And additional information is given for the purpose of EVA calculation, that the cost of equity is equal to 18%, and the market value of shares at the end of the first year is 2,60,000. At the end of second year is 250,000. The market value of R&D is 60,000 for both the years. So let us understand that. We know that EVA is a NOPAT minus the capital charge. A NOPAT is an adjusted PAT, adjusted for the financing anomalies and adjusted for the accounting anomalies, and here the accounting anomaly is the deferred tax. So PAT is equal to 127,850. The net effect of interest, so into 0.30 into 0.70, 1 minus t, and we add back deferred tax because the deferred tax is not allowed as a deduction or removed from when computing the EVA, and the capital charge in the first year. So that is the NOPAT calculation. And in order to calculate capital charge, we have to find the economic balance sheet, and the economic balance sheet will have almost all items in the same way as the financial accounting or the financial statutory financial statements. But the deferred tax liabilities, which was there on the balance sheet, will not be there. And if the market value of assets or liabilities are given, that could have been can be taken too. So the sources of this economic balance sheet as of now is 887,250. No change in the cash, no change in the stock, but the shares market price is 260. No change in the debtor. We take the R&D at the market price 60,000, and no change in the plant. So the total value of the assets is equal to. So assets are more than the sources because the assets have been revalued and the deferred tax liability has been removed, and these are called accounting adjustments, and these accounting adjustments on the balance sheet are actually given a name called equity equivalent. So equity equivalent in this case is 250,000, and this will be recognized as an equity while computing the capital charge. So the equity for the first year is 150 plus 516,850. The long-term debt is 75,000, and the equity equivalent is 56,200. The capital charge will be calculated by using a KE of 18%, and the KD is post-tax 0.70, so 5.6 5.6 and the equity equivalent will also be the cost of equity will be used to calculate the core capital charge for the equity equivalent. So the total capital charge in the first year is equal to the summation of the cost of equity, cost of long-term debt, and the cost of equity equivalent. So EVA in the first year is 8,942. Now let us do that for the second year too. The NOPAT is equal to PAT plus interest 1 minus T, and the deferred tax will also be added back here. So the NOPAT is the adjusted PAT, adjusted for interest and the deferred tax, or in other words, adjusted for financing anomaly and adjusted for the accounting anomalies. In this year also we can prepare the economic balance sheet. No change in the capital, no change in the reserves, no change in the loans, no change in the creditor. The deferred tax liability will not be taken, no change in the equity, and the total sources without making any adjustment for accounting adjustment. Let us also find the assets. No change in the stock, no change in the shares, but the shares market value is given as 250,000. No change in the debtors. The market value of R&D is given as 60,000. No change in the plant. So the total value of the revised balance sheet assets is 108, and as a result there is an equity equivalent of 42,500. So the equity equivalent is accounting adjustments required to convert the accounting balance sheet into economic balance sheet. So equity is equal to 839,700, the long-term debt 75,000, and equity equivalent is 42,500, and we are going to use the same rate of cost of equity 18%, the cost of debt 5.6%, and cost for equity equivalent is also taken as 18%, which is the cost of equity. So the total of the capital charge in the second year is 162,000. So the NOPAT minus the capital charge for the second year is 10,304. So if there is a deferred tax assets or deferred tax liabilities that will affect the economic balance sheet. If there is a deferred tax on the income statement, while computing the NOPAT, it is adjusted for the deferred taxes. So because the deferred tax is not considered as a cash tax, only tax will be taken is a current tax or cash tax. So the NOPAT in this case is adjusted PAT, adjusted for interest and adjusted for the deferred tax. The capital charge includes the adjustment for the deferred tax as well as the adjustment for the market value of the asset, and together it is called the equity equivalent. So therefore the deferred tax will affect the EVA calculation in the sense that while computing EVA, the deferred tax in the income statement is removed and deferred tax asset or a liability from the balance sheet will be removed. So thank you very much.